This is a talk about economic prediction, and in particular I'm going to make the case that economic forecasting is a foolish enterprise. To start off with, I want to take a look at some Bank of England fan charts. Now these were published in August 2006. On the left you can see a green fan chart which is looking at GDP. GDP stands for Gross Domestic Product, and this is a measure of the value of final goods produced in the UK over a specified period of time. It's essentially a measure of the size of the economy, and as you can see we're looking at percentage increases here, so we're looking at the growth rate. Now the Bank of England has a pretty good idea, it thinks, of what's happened to GDP in the past. You can see that it has this line here where it believes that GDP historically has gone up, back down again, up until this point here, which is August 2006, and the point at which the fan chart is published. The Bank of England are acknowledging that it's a lot more difficult to know what's going to happen in the future than in the past. Now, historically, or traditionally, many statistical agencies would demonstrate that they're looking at a forecast by showing a dashed line. The Bank of England pioneered the fan charts because this is essentially a way of hedging their bets. What they're saying is the darker the shade of green, the more likely they believe the outcome. As the shades of green get lighter and lighter, the Bank of England are saying these events are also possible, they're just less likely. What they're getting at is that ultimately the entire area of the fan chart they believe should occur around 90% of the time. So the question here is, given that we know what's happened to GDP since then, how well has the fan chart held up over time? As I said, this was published in August 2006, so let's look 2 years later, which is roughly when this dashed line is here. The question is, what was GDP? Well, according to the Bank of England, they believe the most likely estimate of GDP is going to be somewhere between 2 and 3%. They probably wouldn't be surprised if it's somewhere between 4% or above 1%. But again, 90% of the time, it should be somewhere within this fan chart range. So the question is, was it 2.5%? In actual fact, it wasn't. In Q3 2008, the GDP growth rate in the UK was minus 2%. Not just was it outside this central range, it was actually outside the fan chart. In fact, it was outside the chart itself. We can also take a look at CPI, and we can see whether or not the Bank of England have a better record here. CPI stands for the Consumer Price Index, and this is a typical measure of inflation. Again, we can see the historic data and what the Bank of England knows has happened in the past, but critically, once we hit the time of publication in August 2006, uncertainty takes over. Now, it's pretty clear here that the Bank of England believes that in 2 years' time, inflation is going to be 2%. This is no surprise because the Bank of England's job is to deliver 2% inflation. So whenever you ask the Bank of England what inflation will be in 2 years' time, they will always say 2%. If they didn't think that was the case, they would change policy such that they did think 2% inflation would be reached. Now we can see the fan chart suggests that it's possible that they missed that target, but it should be somewhere between this 1 to 3% band. In actual fact, in September 2008, inflation in the UK was 5.2%. Again, not only is this outside the central band, not even is this outside the fan chart, but it's actually outside of the chart. Another interesting thing is that this gives the impression that the uncertainty is only when we look into the future. But certainly for the case of GDP, we're constantly revising past data. Therefore, more recently, the Bank of England have begun to produce fan charts that not only fan out when they look forwards, but also fan out when they look backwards. It probably won't be long until this entire chart is just filled up with a big green splodge. Now, there's a lot of studies that have been done to see how well economists can predict recessions. This is just a review of a study that was written in 2008 and applied to economists working in the 1990s. It looked at the predictions of a large group of economists in 60 different national recessions that occurred in the 1990s. And what the study found was that in 97% of the time, the economists failed to predict the recession a year in advance. A year is just far too far away from the event for economists to have a clue about what's happening. On the rare occasions when economists did successfully predict the recession, they significantly underestimated the severity of the downturns. And worse still, many of the economists failed to anticipate recessions that occurred as soon as 2 months later. So even 2 months head time isn't enough for economists to have a good idea about what's about to happen. And we can summarize some of these empirical findings by saying that economists are no better than Baba Vanga. Now, it may be that I'm being a little bit harsh, and you may say that economists generally are good at making forecasts. It's only in certain circumstances where those forecasts fail. What I'm showing you here is GDP growth rate for the UK from 1994. It's true that the fan charts I showed you for the Bank of England applied during the financial crisis, and many economists have made the claim that that was a unique and chaotic period of time where forecasts shouldn't be expected to hold up. But I just want to question whether or not we let economists off the hook this way. If it's the case that forecasts are successful when the economy is doing reasonably well, but they should be expected to fail when things unexpected happen, we have to question what the value of the forecast is in the first place. For example, we can see that from 1994, GDP growth was somewhere below 5% and somewhere above 2.5%, roughly between kind of 2.5 to 3%. And for many years, this was the GDP growth rate. If we come to the current point of time here, which is around 2006, and we say to ourselves, what do we think GDP will be? Well, do we need to have some highly trained, very expensive economists to make forecasts with complicated models? If we just said to a 5-year-old child, what do you think GDP growth will be next year? Then the 5-year-old child will probably just look at what's happened in the past and extrapolate, and indeed, guess what? It carried on around 2.5%. Surely what we really want from economists is a heads up when something like this happens. And if this is when the models fail, then we have to question what the success rate and what the value of those models are going to be. Just so you know, this is actually what happens to GDP after. This is a serious economic event that very few people saw coming. We can look at this in more detail. We can see some forecasts for the UK economy for 2008. Now, this is a range of independent consensus forecasts published by the UK government. These are all a combination of public and private forecasting agencies that are giving their prediction about what the growth rate for the UK economy will be in 2008. Note, these were published in the middle of 2008, and the data actual value is 0.6%, minus 0.6%. Now that's true as of March 28, 2014, and is always subject to revision. But you can see here that there's a massive difference between what these economic forecasters thought would happen and what the actual value was. Out of interest, the only company that came reasonably close was Economic Perspectives, who correctly forecast that the growth rate would be less than 1%, but even they didn't realise that it would be negative. We can also look at 2009. Again, we've got the same range of companies, and these are their 2009 estimates. This is even worse. The actual value was minus 5.4%. We can see that the highest estimate was 2.7%. This was made by Macroecon. In June 2008, they believed that the 2009 growth rate would be 2.7%. The median growth rate was 1.6%, so this is what the median forecaster predicted. And the only company out of all of those forecasters that thought that it would actually be negative was once again Economic Perspectives. We can see that almost the entire profession was not only in relatively close agreement to each other, but they were also pretty much wrong. This has been what Andy Haldane has referred to as a methodological monoculture. He presents the following chart, which is called Chart 1, and this is a range of GDP forecasts made in 2007. It shows a range of forecasts from 27 different economic forecasters, and that includes the Bank of England, made in 2007, which is the dawn of the financial crisis. And he points out three things. He says, firstly, notice how all of these pre-crisis forecasts are very tightly bunched in a range of around just 1 percentage point. He suggests that this is possibly because they were drawn from similar models. He says the methodological monoculture produced, unsurprisingly, the same crop of forecasts. If we actually add on over the top of this chart and see what the latest vintage of GDP data was, this was published in November 2016, we can see what actually happened to GDP. It fell dramatically. Now, this is a point that Robert Lucas, the famous economist, has made in the past. He says the charge is that the forecasting model failed to predict the events of September 2008, yet the simulations were not presented as assurance that no crisis would occur, but rather as a forecast of what could be expected conditional on a crisis not occurring. In other words, there's almost an inbuilt assumption to a lot of these models that a crisis won't occur. There's an acceptance that if something shocking happens, then the model loses its service and its value. Again though, if we have to make the assumption that a crisis doesn't occur, why can't we just extrapolate from the past trend and make things very simple? Famously, in 2008, the Queen visited the London School of Economics, and she asked, if these things were so large, how come everyone missed them? And this is a question that caused a lot of people in the economics profession to really struggle with. How come nobody saw the crisis coming? I think there's two ways we can respond to the Queen's question. One response is we can say, well, actually, Your Majesty, some of us did see it coming. Perhaps not the entire profession, but some of us did. In a paper called The Paradox of Prediction, published through Collidic Economics, I have a survey of those who did claim to have seen the crisis coming, and we can see evidence that some people demonstrated some very interesting prescience. In fact, I can even give examples from myself. In November 2006, I wrote that an inevitable bust was going to occur. In March 2007, I wrote that New Century Financial was on the verge of bankruptcy. Also in March 2007, I warned that contemporary central bankers had not yet been properly tested. And in April 2007, I said that we've been living beyond our means and the crunch is coming. So at the time, there was a lot of people that were warning that problems were going to happen, and I was familiar with a number of people making these arguments. Having said that, instead of saying to the Queen, we did see it coming, Your Majesty, we may also respond to the Queen by saying, well, do you know what? Maybe economics shouldn't expect us to be able to forecast these types of events. This is the approach of Jeff Hodgson, for example, who replied in an open letter to say, Your Majesty, economists did something even better than predict the crisis. We correctly predicted that we would not be able to predict it. And it's this kind of second approach that I'd like to dwell on now. This is my explanation for why economic prediction is nigh impossible, and therefore trying to make forecasts is foolish. When we learn economics, we tend to focus on an understanding of economic models. We tend to understand models that link economic variables to macroeconomic outcomes. And indeed, this is the reason why I made the predictions that I did in 2006-2007. I was looking at what was happening to house prices, I was looking at what was happening to the money supply, and I felt that the economy was due a correction and that there would be a recession. The problem, though, is that that information and that knowledge of economic models isn't sufficient for an economic prediction to be accurate. What I completely failed to understand in 2007-2008 was the scale and the type of interventions from central banks and governments in response to the economic fundamentals. We can refer to this as policy uncertainty, And this is the fact that we need to understand how policymakers are going to respond to the conditions for our prediction to be accurate. If we look around the world now, if we look at the United States, for example, if you want to have a good understanding about what's going to happen to the US growth rate over the next few years, a good understanding of economic models is probably not going to be sufficient. What you really need to be an expert in is being able to anticipate and understand how the president is going to make his decisions and what those decisions will be. Similarly, when we're talking about the UK economy, one of the critical elements of uncertainty is going to be Brexit. And so this is why a lot of people give their attention to what's happening in the government, their attention to what the kind of deal is going to be struck, what deal the UK government are going to try and strike, what deal they're likely to strike, and that's going to drive a lot of economic events afterwards. The point, though, is that it's a very different skill set to be able to understand economic models and to be able to navigate policy uncertainty. The former, your focus is going to be on economic data. The latter, your focus is going to be on the public statements of politicians and an understanding about elections, alliances, and other forms of political theatre. But even if you have a good grasp of the economic models and the policy uncertainty, there's still other factors that we need to consider. In the case of the financial crisis, one of the kind of instigating points of that was the fact that there was a downturn in the house price market. One of the things that led to that was that there's previously a house price boom, or some people would argue a house price bubble. If we think about the contours of a boom, if people expect houses prices to continue to rise, then they'll continue to buy housing, and this is going to cause house prices to continue to rise. Once people expect house prices to fall, this is when they'll try to get out of the market, and this is when the crash will occur. Similarly, if people expect a recession, then they'll withhold their spending, and this in turn causes a recession itself. In economics, we have these concepts of self-fulfilling prophecies, whereby the expectations of the agents in the economy can actually have an impact on the outcome. So the point that I'm trying to make is that if you want to make an accurate economic prediction, you need to have a good grasp of the underlying economic models. You also need to have a good grasp of the policy uncertainty, and you also need to have a good grasp of expectations of the people that are playing the game. We learn about economic models in macroeconomics. It's more of a political economy discipline that teaches us to understand and navigate policy uncertainty. And really, it's the fields of psychology and the field of sociology that helps us to understand the expectations of a large number of people. The point here is that very few of us are experts in all three of these disciplines, and moreover, none of us are experts at understanding the balance between the three of them and how they all combine to drive our economic predictions. Now, this doesn't mean that we can't see into the future at all. Immediately after the Brexit vote was announced, the FTSE 100 fell by 8.7%, and pound sterling fell around 8% relative to the dollar and was down 5% against the euro. Now, it was very clear that this was a big shock and a big surprise. Both opinion polls and prediction markets implied a slim Remain victory, and most people were expecting a Remain victory. The subsequent surprise revealed a very big problem, though, with how we approach the future. The whole purpose of forecasting is about trying to identify the most likely outcome. And in the run-up to the vote on Brexit, the issue was what the percentage would be for Remain and what the percentage would be for Leave. Once that slim Remain victory was announced, people expected a Remain outcome. The problem that forecasters face now is that they have to recalibrate their models to try and attain more accurate probability values in the future. And a lot of time is being spent now to try and improve those models and improve the forecasting. But if forecasting is foolish, then maybe that's the wrong approach, and there is an alternative. For example, we can look at things like scenario analysis. In scenario analysis, instead of trying to identify the most likely outcome, the aim is to consider a range of all possible outcomes. Rather than trying to predict the future, you're just trying to recognize what potential futures could occur and then plan accordingly. A way to summarize this is that the question shouldn't have been how likely is Brexit and to try and put a number on that. The question should have been what should we do if we leave and what do we do if we remain. This allows us to plan for the future, but it avoids the trap of trying to make forecasts. Thank you.